When you talk about the market, the macro outlook of the United States is not indicative of pocket economies. So when you look at the overall averages of the United States and you look at these things, they're being bastardized by the numbers out of, Los Angeles, San Francisco, New York City, Chicago, and it skews the average to a place that you can't make appropriate investment decisions within pocket economies. So you need to underwrite deals.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Ari Rastegar has been dubbed the Oracle of Austin by Forbes and listed as one of the Commercial Observer's 100 most powerful people in real estate. The self-made mogul built an empire boasting hundreds of millions in assets across 38 cities. Ari, welcome to the show.
Hey, thanks for having me.
The pleasure is mine, Ari. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Sure. 90 seconds will be tough. But I started the firm with a $3,000 loan when I was back in law school. And kind of after 2 community colleges and delivering pizzas and flipping burgers through high school, was kind of a run. Moved to New York City, spent several years on Wall Street, and then came back to my hometown in Austin to really launch the firm. And as you mentioned, we've now successfully invested and exited in 38 cities, 12 states, and 7 different asset classes.
That is a lot of momentum to build from a $3,000 loan. What year was that you graduated?
That was 2000. That was 2005, and I was running that initial firm for a couple years, and then 2008 happened, and that came to a screeching halt. Luckily, I got my $3,000 back and my scholarship money, and I spent a few years on Wall Street working for some of the greatest minds in the world, and started this brand, Rastegar, about 7 years ago.
When did you know you were onto something? I mean, there's a lot of moving pieces there, but at what point did you say, "Man, I've got a viable business plan, and I'm going along with whatever that was"? When was that?
Well, the impetus for Austin, which is obviously a big part of our business, or the Austin MSA, I should say, was in 2013 when Google chose Austin as their beta city to lay $1 billion of hardware to bring Google Fiber to the city. And when the ability, I guess, of financial service companies, technology companies to utilize Austin became viable, it became, pretty indicative that the city was going to do something special. And the city's gorgeous, right? We have more public parks than any top 10 city in the United States. Cities built on lakes, the hill country, full of trees. And I guess the cheeky way of saying it is it's really easy to get to Texas from Austin. It only takes about 15, 20 minutes.
That's awesome. So you saw these improvements happening in the city. You saw Google Fiber coming to town, and you said, "Hey, we're going to go long in Austin," but yet you're in 38 cities.
Yeah. And so, when we were starting the firm, it was really important from a risk mitigation standpoint to, not try to do too many things at once in-house, meaning, it was only in probably year 4 of the company till we started doing our own in-house property management, our own in-house acquisitions, equity stacks, debt financing. So before we started in a co-investment structure of working with some of the best operators in the country and investing alongside them in, LP structures, originating debt, but really, piggybacking alongside their acquisition methodologies and their ability to execute. And so we were able to cast a very, very wide net early on to be able to show the market that we had deal flow, show the market we could create alpha in several different asset classes. We've always been agnostic to the asset class. We're very much, deep value and IRR driven. And once, we were able to execute, it made sense for us then to start bringing more of the methodologies in-house. And that's what we've done. And so, today we have a 24,000 square foot office building under construction at the hard corner of East 8th and I-35, which is, dead heart, in the middle of, the most robust part of Austin, which will end up being our global headquarters as well. So it's pretty cool because we have in-house architecture competencies, in-house civil engineering competencies, that we actually acquired the land, in-house. We were able to go through the zoning practices. We designed the building and brought on Corgan, one of the best architecture firms in the world, to be our architect of record. And now we are developing the property ourselves. So it's, a really exciting time to kind of go soup to nuts and be able to be responsive to the environment, because it's very much a post-COVID structure, having staircases on the outside, windows that open and close, and a variety of health mechanisms on the inside. We're even conceptualizing using a product that has these specialty lighting that replace LEDs that actually enhance cognitive function and helps your brain stay in line with circadian rhythms, and just bringing health and wellness to the forefront through the practice of real estate.
That's really cool, and I think that's something that's lacking in the marketplace is bringing that health and wellness. We
agree.
Tell me about that. Obviously you see the need, but then monetizing that need and making it a profitable venture can be two separate things. How have you found a viable business plan in both of those?
Sure. It's look, you got to sharpen your pencils, no question. But for us, it's about staying in line with the core values of the firm. And anybody that knows me knows I'm a health fanatic, to say the least. And so these things are very much an extension of what we believe as a firm. So building in these different methodologies, whether it's touchless entry, whether it's specialty HEPA filters and LED lighting, won't affect the budget, as dramatically as some of these other changes will. So I think the key is not trying to do everything all at once. It's trying to kind of pick a little bit of a corner that stays in line with that core value, and letting that grow organically. So in this particular instance, putting staircases on the outside of a 2-story building, wasn't a dramatic change to what the overall line item budget was. But, for, prospective tenants that would want to be a part of this building, being in this post-COVID environment, it's a huge value add. So the key is, when you add in any of these health components, it needs to be a value add to the end user tenant, not just being done, for show or trying to check an ESG box. And when you do something that's actually creating value for the end user tenant, whether through, health and wellness, through the architectural design, the interior designs, et cetera, it tends to be absorbed in the market much more quickly than trying to force it down their throat.
Absolutely. No, I love that. One of the things you said here a few minutes ago was that you've been asset class agnostic. Is that still the case today?
It is. So our predominant focus, we've been in self-storage, student housing, office, industrial, retail, you name it. And when the time was right, back in 2016, 17, we exited a lot of our retail positions and exited a lot of our self-storage positions before the market changed. So, we still have a very good taste in our mouth about those asset classes in the past, but that's clearly not going to be the bulk of, where we're focused now, nor is office, quite frankly. If this wasn't going to be, our headquarters and wasn't a smaller footprint type strategy, it wouldn't be in line with, what we believed. The location is second to none in Austin. It's a boutique building. And so we had a lot of risk mitigation strategies in place. And because of that, the demand has been off the charts. Our core focus is around multifamily acquisition, namely value add, vintage multifamily, 1960s, 1970s product. That we can go in and gut renovate and bring to a class A interior, and charge outsized rents from what the product was originally, along with industrial development. We have 600,000 square feet of industrial that we're building on 50 acres close to the Austin airport, and just a hop, skip, and a jump from Tesla's Gigafactory. So if you look at cities that are growing, namely in the Sun Belt, whether you take the Austins, the Dallas, Nashville, Tennessee, Phoenix, Raleigh, North Carolina, Tampa, Orlando, Florida, any of these cities that share a similar ethos to Austin, they're going to need apartments, because the people coming are transient. And so when you come in transient for a new job, you're not necessarily looking to buy a house, day one. You kind of want to get your feet wet, understand what schools you want to be in if you have a family. So the need for apartments is dramatic. One. Two is supply chain logistics, industrial. So those are the main things that we're really focused on, in addition to building industrial and building multifamily. So that's our core focus for this foreseeable future within the Sunbelt geography. But, I'm never scared of a good deal. So I joke with people all the time that, I'm always a buyer and always a seller. You might not like my price as a buyer or a seller, but I'm always a buyer and I'm always a seller. I'm happy to pay $20 million for the Plaza Hotel that's worth probably $1 billion. No one's going to sell it to me, but I would buy it.
I love that. Was it hard when you had?
Yes.
What's that?
Yes. If you're asking if anything was hard, the answer is yes. You can end the question.
End of the question. Yes, it's all hard. That's a fact, and it's
all hard and expect it to be hard. Don't expect it to be easy. If you do, you're fucked.
There it is, folks. There it is. Straight from the horse's mouth. Question for you is this. You built these verticals. You built, self-storage. You built whatever else you were invested in, office and XYZ. Was it hard pairing those off or kind of slowing those operations down, saying, hey, look, we're no longer buying self-storage. We're no longer.
No, it's not. I mean, you look, at the end of the day, this is all about your investors and all about creating value for your clients. And it's also about following the debt mechanism. So, as we kind of joke, you have to kind of, when the bond gods speak, you need to listen. And at the end of the day, all mortgages, or the vast majority of mortgages, are then bundled and sold off as bonds. So watching the bond market very closely and understanding what the bond gods are wanting as for offerings really show you, where in the market there is going to be financing opportunity, because real estate really doesn't work without accretive financing. There's other businesses that have better margins, have lower risk mitigation strategies if you're not using financing, if you're not getting, quote, levered returns. So, when you watch these asset classes start to get hot, that's when I kind of pull back a little bit. We were buying self-storage when people gave me this kind of sideways look of, you're buying a shed? Like, hold on, what is that? Like, that's the least sexy thing ever. And my response was always that the financial statements is the sexiest thing I've ever seen. Right. So it's really about just being responsive and not getting too emotionally attached to, your own strategy, your own thing. And remember that you're here to create value for your investors. And when you have that at the core, at the front of mind, it's easy to pivot into other places where there's deep opportunity.
Absolutely. What are the bond gods telling you right now?
The bond gods are telling me right now that multifamily is probably the most accretive asset class at the moment. Fannie Mae and Freddie Mac are as robust as they've ever been. The interest rates, obviously are starting to go up to counteract inflation. A lot of people, that's scaring the shit out of. For us, we see it as a huge buying opportunity because a lot of our competition is sitting on the benches. And I've always looked at it like, if 100 basis points in financing is ruining my deal, I have no business doing that deal.
Yeah, that's absolutely right. And I've heard that from a lot of people who come on the show. This is a daily show. And I've heard this more and more where people say there's a softening in the multifamily market, whereas previously there may have been 20 offers on a property.
Well, look at it this way. So when you talk about the market, the macro outlook of the United States is not indicative of pocket economies. So when you look at the overall averages of the United States and you look at these things, they're being bastardized by the numbers out of, Los Angeles, San Francisco, New York City, Chicago, and it skews the average to a place that you can't make appropriate investment decisions within pocket economies. So you need to underwrite deals not only on a city by city basis, by a block by block basis. So you need to not only zoom in to that city, but then zoom in on the micro corridors and underwrite risk within the micro corridors. So if you look at Austin as an example, we're 100,000 units short of apartments. 100,000. Think about that number. They say, multifamily softening. Not in Austin, Texas.
Right.
So you need to look at the market that you are investing in and make educated decisions based upon those in particular things. And I don't want to say ignore the macro outlook. It's always should be under consideration and understanding it. But to make investment decisions about Austin based upon what's going on in New York is just idiocy.
Yeah, absolutely. What are you guys doing about that 100,000 unit short there?
Building more.
Tell me about that.
So we have on a master plan development in Kyle, Texas, we own 318 acres and we're building a substantial amount of houses build for rent, and which is another one of the strategies that we're very keen on for the foreseeable future. And then we have about 1,400 multi-units that we'll be developing within that corridor over the next 5 years. In addition to a multifamily development project on South Congress, which is, the most famous street in Austin, in addition to continuing to make acquisitions, rezoning some existing properties, existing multi that we have now for more height and more density, and just creating opportunities that will be able to house these, transient individuals coming into Austin.
That's awesome. That's a lot of moving pieces there. How have you maintained or gained traction? I mean, one of the things that, you said early on was you guys have been in a lot of different asset classes. How did you gain traction with a wider focus?
Yeah. Again, it's look, I've been involved in pretty much every asset class in all parts of the capital stack my entire career. And because of that, developing very, very deep relationships from New York on down, with the brokerage community, with the financing community, with the investment community, and just listening, really listening to where people want to be, where people are comfortable with, and really sharpening our pencils on where value is, creates scalability. Because at the end of the day, if you can solve a problem for a public pension fund, solve a problem, for your investors, or be in a place, with your banks that fit within the box and them to be able to finance, you have to be sensitive to all these different positions. And once you're sensitive to those positions and you have the outlook of creating value, for your clients more so than yourself, opportunities present themselves.
That's absolutely fantastic. I love that. Tell me about a time when you got something wrong or you made a mistake.
I wrote a whole book about it. So The Gift of Failure, my book, will tell you more than you ever wanted to know. Every chapter covers a cataclysmic failure that I endured and a lesson that was extrapolated from that failure. And so I literally spent, the better part of 18 months deep diving into those issues. And I assure you, there was more failures than I'd care to admit, but now that's in writing, it's there for the world to see.
Do you feel like is failure just part of the process? And it's a great
question. It's something that we talk about on our podcast that came out last week with some of the greatest minds, spiritual leaders, celebrities. That exact question, and I've come to think in my mind that success and failure are kind of two sides of the same coin, and to bifurcate them and call them different or put a negative connotation on failure and a positive connotation on success is just inaccurate. When you're 1 or 2 years old learning to walk, you stand up, you fall down, you stand up, you fall down, you stand up, you fall down, and your parents don't say, "Oh my God, Billy and Jane will never walk ever again." You just keep going through that process, and you quote, as John Maxwell says, you fail forward.
Right.
And so I've come to realize that failure itself doesn't denote success. It's the introspection into failure, extrapolating a lesson by putting the onus on yourself and not putting the blame into external factors. Using that lesson to then progress is what leads to success.
That's absolutely awesome. Tell me, I guess, when it comes to scaling, what's one piece of advice you would give to somebody maybe earlier in their career? What's one piece of advice maybe to go back and give yourself earlier on if you could, and say, hey, here's a way to move further faster?
I'll give you a different answer. The best way to scale in your business is to scale yourself. And so your business is a limitation of you. It's almost like you're the trunk and your business is the branches. So in order to scale the business, you need to invest in yourself. You need to find all the points where you are standing in the way of your own success, whether that's the extra 20 pounds you need to lose, whether that's, kicking some, habit of smoking or drinking too much, whether that's, learning to meditate, whatever your issues are, and whether we like to admit it at all, we all know what the maladies that we suffer from. So what I would encourage people to do is find one of the maladies, find one of the vices, find one of the things that's hindering you, and attack it with reckless abandon. And what will happen is that will free up the space and build self-confidence and unlock that sleeping genius, for lack of a better explanation, within your brain. And the scaling of the business will be a natural iteration.
That's awesome. Absolutely love it. Ari, thank you for taking the time to come on the show today.
Thanks for having me.
If our listeners want to get in touch with you, learn more about you, your podcast, your book, how do they do that?
Yeah, so the podcast is called The Gift of Failure. You can go to the Apple Store and find it there. It's also on Spotify. The book releases on September 27th, and a simple Google search of my name, I'm pretty easy to find, unfortunately. So if you want to find us, the company's Rastegar Property, and shouldn't be too hard for you.
Fantastic. Ari, thank you again for coming on the show today. I certainly appreciate it.
Thanks, buddy.